Good morning, ladies and gentlemen. Welcome to the show. Listen, I'm glad to have you guys here on this Thursday, the 17th of September, 2020. Now, I guess I'm going to boil it all down for you guys. I mean, I've had a number of shows, and one show I said, well, we could have an economic recovery, And in my last show, I've doing warnings about if they're too stingy. Well, here's the thing, and this is what it boils all down to. If they're not stingy with the money, we could come into a economic recovery, but it's not going to be a super vibrant economic recovery, but it'll be a recovery, right? But if they're real stingy with the money, if they don't overhaul the social programs, if they allow all these people to end up, and Main Street could go into an economic depression, and that's the main part of the economy. In other words, if they're stingy with the money and they keep holding it back, we're headed toward the worst economic crisis all over the world, and then the Great Depression, worse than the Great Depression. Magnitudes worse than the Great Depression is what we're headed straight toward. And it all depends on what they do now, what they do in the next few months. If they're stingy, or if they're going to be loosey-goosey with the money, and see, the system runs on money. Everything runs on money. And I mean, okay, I know I'm saying that, and I know that's a no-brainer, but this is the fact of the matter. And if they want an economic recovery, they got to keep that money coming. They got to keep the flow of money coming to Main Street, not to Wall Street, but Main Street right now is drying out. It's drying up. And so this is what it all hinges on. Is on what they do in the next few months. But I'm going to talk just for a minute about what that, if they're stingy with the money and we go into a depression, what that just might look like. Because we're not like we were back in the 1930s when we went into the last depression. People are completely different now than they were back then. The people now are privileged. You take all those privileges away suddenly, and their expectations are all gone. And people, it's going to be a nightmare. What could actually happen, depending on what they do. So this is why it's so important that they support Main Street in its time of need, and continue to keep supporting Main Street until this virus leaves. Because a virus is a player in all of this. It's the reason we're in the state we're in right now. Anyway, let's get started. Let's open up the charts right here and take a look at what's going on. The gold price today, it's down a little bit. I notice when they ram gold down now, it tends to spring back, And if for you guys out there that haven't been following this for a long time, this story of gold price and silver price manipulation, what they do is they create paper silver and paper gold in massive amounts, much more than the actual underlying physical asset. And then what they do is they use those as a method to control the price. They might sell on the COMEX, they might sell in one day more silver than is mined in an entire year in one day in order to manipulate the price upwards or downwards. And they've been doing this for a very long time, just to bring you guys up to date. And it's getting so now it's hard for them to do it. It's getting so now that the price wants to maintain a higher price even through the manipulation. It's getting more and more difficult. So that's what's going on. Anyway, look. 1943 for gold today, which is a good price for gold. That's high compared to how low they kept it for years, And here we're looking at a price of silver at it's down 22 cents. It's at $26.92. So silver right now is a terrific buy because they've knocked the price down below $27 again. But it's getting harder and harder to actually obtain the actual physical silver metal. That buying it and actually holding it in your hand is getting more difficult. You have to pay premiums now on it to get it, and those premiums, depending on what the spot price does, those premiums could actually go up a lot higher. The premiums could go massively high depending on what they do with the spot price. And what that actually is it's a separating between the price to buy physical and the price to buy paper silver. That's what a premium is. It's a separation of those two. And when it becomes more and more, the premiums become larger and larger, then it means that the price is actually separating away from the spot price. At a certain point, it could actually become absurd. Because if we go over to U.S. Debt Clock and take a look at what they say that the silver price should be, it's like $3,800 an ounce. That's where it should be, considering how much money that they've printed over the past few years. Anyway, let's take a look now at cryptocurrency, and we're looking at $350 billion industry at 57.4% Bitcoin dominance. And we're looking at a Bitcoin price of $10,874 today. This is an alternative to, for the longest time through history, the only place that you could hide if you wanted to get out of the dollar and into some other asset class was gold and silver as a hedge. That was the only hedge. And what we're looking at now is a new hedge. This is a new hedge, cryptocurrencies. I know a lot of people don't like it, but it's new technology, and it's very slowly making its way, just as new technology always does. New technology, like when they first brought the car out, most people didn't want cars. And they were still into horse and buggies. And the horse and buggy, seemingly, when you first look at it, the horse and buggy is more reliable. Back then, those early cars, they were basically clunkers. And they get stuck a lot, and they made a lot of noise, and a lot of smoke come from them, and they were expensive. Where the horse and buggies, you could buy a cheap horse and buggy, and it was quiet, and it didn't make any noise, and it was just the way to go. And it looked like the car would never make it. And that's the same way with crypto right now. It's in that same stage of development. Let's take a look now at the Dow Jones Industrial Average. It's down 60 points on the day so far. This is starting to look more and more like a peak. 29,100. It's starting to look more and more like a peak until they inject more liquidity. This is the peak. It's not the peak if they want to inject a lot more liquidity into the system. And the they I'm talking about is the Fed. So this market's totally reliant upon the Fed now at this point. It's not reliant upon fundamentals anymore. They're putting all their money in just a handful of extra large companies, and like the FANGs and stuff. I mean, it's just, and we got so many Robinhood traders and everything. It's just the markets. This is it's really something what's going on. I mean, I can't really get over it. But if the Fed were to pull out support at this point, because they're the only support, there'd be no bottom. The bottom would be so far down there. I mean, we could be looking at if the Fed didn't support this market, we could be looking at a slow grind downward. It wouldn't be slow at first. It'd be fast at first, but it would keep slowly grinding down. And over about a 3-year period, we would go all the way down to about 3,800. Imagine a Dow Jones of 3,800. That's how far down we would go before we'd finally find bottom. 3,800. You imagine what the economy would look like at 3,800 Dow. Okay, that's where we're standing with this thing. And that would take about 2 or 3 years to get there, down to 3,800. But can you imagine the economy? There would be people all over the street corners sleeping in blankets on the street. There would be people I mean, there'd be people expiring right on the street in the United States of America. That's what the country would look like if the Dow goes down to 3,800. There would be people freezing to death at night in the northern cities with nobody to even care because there'd be so many of them. That's what the country would look like with a Dow 3,800. And I mean, okay, the alternative to that is hyperinflation. So they get the choice. Support or not to support. You know, either way is a disaster because hyperinflation would be a disaster. But I'm going to tell you guys what. In my mind, the hyperinflation would be a lesser disaster than if they don't support it. The deflation's a bigger disaster. The deflation is a disaster where it's unimaginably horrific. I'm not even going to go into details about if they let it all deflate and the Dow goes down to 3,800. I'm not even going to go to details about how bad that would be. Where the hyperinflationary scenario, not quite as bad, guys. It's not quite as bad. It would still be bad, very bad, but not quite as bad, you know, and it would take a bit longer, you know. But in general, the big part of this crisis is probably about 2 years away. And either way they go, hyperinflation or deflation, your lives are all going to be changed. Nothing's ever going to be the same. And we can't get out of this. It's going to be either deflation or hyperinflation. And there's no choice. There's no third alternative, guys. We're heading there. We're on the road. And unless something absolutely out of left field were to come, take me by surprise, we're going to get there. And it's probably within the next 36 months, all of this is going to play out. And all of your lives are going to be changed. My life's going to be changed. All of our lives are going to be changed. Everybody on Earth's life's going to be changed. You have no idea what is coming, and there's no way out of it at this point. We are quite literally on a train coming down a mountain, and the train's ran away. And the train's going faster and faster, and we got monkeys for conductors. A bunch of monkeys running around it for conductors of the train, and the train's going faster and faster down the mountain. That's the situation that we're in right now. And yes, we haven't crashed yet, but the train's up to 70 miles an hour. Soon it'll be up to 90 miles an hour. How fast can that train go before it leaves the tracks, guys? Really, I mean, you guys might look at me and say, hey, he's being an alarmist. He's a fearmonger or whatever. No, I'm telling you the literal situation that we're in right now. This is exactly what's happening. Okay. Crude oil, 41.14 today. It's up a little bit. It's almost back up to the level it was at 43.39. So we had a dip. This is looking like more and more like a dip in crude oil price, you know, where it went down to 36.76. Okay, but she's bouncing back. She's heading back up to 41 bucks. Let's take a look at bonds and rates today, and we're seeing falling yields today, but it's all the way across the board. It's not significant, and we're looking at 0.68 on the U.S. 10-year. And 1.42 on the U.S. 30-year. Take a look at the dollar, 93.07 today, and it's moving downwards today. Had a little spike in the dollar there, and that was coordinated with the drop in the price of gold. And now we're seeing the dollar drop, and we're seeing gold go up. You know. Thank you guys for listening to my show. Like and subscribe. Give me a thumbs up, and we'll catch you guys in the next episode. Bye-bye.